Good afternoon, everybody. Welcome. Thank you. It's my great pleasure to be moderating that panel here, Crypto Through a Global Macro Lens. Crypto, I think, is macro. Bitcoin is macro. We've heard it many times today and yesterday that it now appears on Bloomberg, on CNBC. Bitcoin is really everywhere, but what does it mean? So many interesting questions. So happy to welcome Christophe, John, Will, and Simon. And maybe we start with a round of introductions. What piqued your interest in crypto? How did you get into that space? I always find that very interesting because most people are not crypto natives. They make the transition from TradFi into crypto. So Simon, start with you. How did you get in that space?
Oh, wow. So my background is options trading. I've been trading 20 years FX options, BNP Paribas and StanChart. And it's just getting to be a very dull place. Whereas crypto options are very exciting, fast-moving. It's got everything that a trader looks for in a market. You know, there's opportunity, there's growth, and there's lots and lots of flow. So for me, it was a natural choice to make the jump over. I did a few years trading PA for myself. And then I was invited to come and join QCP Capital, which is one of the leading option houses for crypto assets.
Yeah. Hi, my name is Will Peets, CIO of 100 Acre Ventures. In terms of how I got into crypto, really I started lending cash on Bitfinex about 6 years ago because it's attractive yields, and that's really what piqued my interest. And then, you know, from there, kind of the rest is history. I worked at a global macro fund for the better part of 7 years, which took also a big interest in crypto, and then have been managing crypto formally for the last 5 years.
Sure. So John Cheesman, institutional sales at FTX. I spent about 15 years working on Wall Street and foreign exchange. Crypto, I suppose, is pretty close to a currency. I just, you know, when I looked at it in 2016, you could just see from trying to think about total addressable market, look at something like remittances and say, well, if just a small amount of people start seeing the opportunity and the use case for Bitcoin, the potential for this to be, you know, a hell of a trade is pretty asymmetric. So that's how I got into it, went down the rabbit hole, found my day job a little bit on the boring side, like Simon, I guess, and you know, decided to take the leap.
Hi, everybody. My name is Christophe de la Celle. So I'm the director of institutional business at Binance. Similar background to John, traditional finance, banking, and hedge fund trading. But I actually stumbled into crypto through fintech. So back in 2016, we started to work, I guess you call them the sort of initial iterations of crypto hedge funds. I mean, back then, anybody who had made 500K in crypto wanted to launch a hedge fund. The landscape's a little bit different now. So it's been a few years now that I've been on the institutional side of crypto.
Great. So let's set the macro scene. Sovereign debt going through the roof, fiat currencies debasing, maybe not, but people here in the room probably say they're debasing. Inflation probably isn't transitory. Interest rates are zero, negative. I mean, German yields where I'm from is kind of like negative to the 10-year, 20-year points, something like that. Implied volatilities are super low. It feels like there's a rubber band that's stretching and at some point something bad's going to happen. Then you have Gary Gensler, who's becoming increasingly outspoken about crypto regulation in the United States. So stuff's moving. At the same time, we have that asset, or it's not just Bitcoin, it's the assets. You know, depends on what do you want to do? Do you want to start with just Bitcoin, or is it also Ether for institutional investors? Is it Cardano? I mean, where do you start? Where do you stop? I don't know. But it's still this asymmetric trade, I think, that you can size appropriately. You can be long. So, Simon, why do you buy Bitcoin? Where do you think that all fits in? Where are we?
I'm just a simple trader. So I like to think of things, you know, sort of in the context of FX. And for me, crypto is not an asset class. It's a whole ecosystem. It's a country, and it's a country that's got a lot of different financial instruments that you can trade. We've got a lot of different coins, of which BTC is just one of the benchmark instruments that we use to trade, but really what we're trading is the whole digital economy. In the same way that you might buy Real or Thai baht because you want an exposure to that economy and because of the growth that you see in that area. I see BTC as the entry point into the new digital economy, and this isn't just a regular country we're talking about, right? This is an extremely fast-growing, high-growth, energetic area. So for me, BTC is just the start of it, but really what we're looking at is a whole world of instruments, all fitting, all playing a different part inside that country. We've got the bonds, we've got credit, all of these aspects, and most excitingly, all of these different new instruments in the form of DeFi and perpetuals and things like that. This is where the real fun is.
I suppose one of the developments this year has been actually that there are now multiple entry points. BTC, traditionally has been the first stop for everyone, but I suppose the most obvious one now is with NFTs. People are finding their way into the digital ecosystem through those, through stablecoin lending, and through Ethereum now as well, which I think is one of the biggest developments of 2021.
I think from a macro perspective, I think the market's starting to understand that crypto is effectively a pressure release valve for the entire economic system, right? I think, it's funny when people talk about crypto being manipulated, or that's one of the concerns of Gensler, but in reality, we have structural manipulation across the entire financial system, whether it's printing of dollars, suppression of credit spreads, whether it's a true manipulation like LIBOR. And because Bitcoin and digital currencies are peer-to-peer, it allows for a much purer market, like actual true market efficiency. And I think the crypto market's finally coming around to that. So in 2017, 2018, everyone's saying, crypto's benefiting from easy monetary policy, people going out the risk curve. I think that's certainly true. I think now it's becoming, because it's matured and you're seeing a lot of different applications and use cases, and it's easily accessible, lots of fiat on-ramps, it's kind of taking on a much more important role. And we'll see if correlations continue to break down, but recently, over the last few days, it's been interesting to see, at least in the US market, a lot of weakness while Bitcoin trading well. So I think the market's coming around to understanding its role as a macro investment vehicle.
Maybe just to add to that, if you're a macro PM, your job is to identify and then capture big trends. Crypto is the trend, the exponential trend. On and beyond macro portfolio managers, you have other portfolio managers that can see that that's where the returns are at the moment. And if you just look at the price, all the information is in the price. If you look at sort of the context of extreme bearishness, the price floor is just going up year after year. 2011 it was $2, 2015 $200, then $3,500. Maybe this year it'll be $30K. So you just can see the sort of exponential rate of adoption.
Sure, from a trading perspective, if you're a trader, I think trading the crypto markets is absolutely fantastic. If you're trying to compete against other traders in arbitraging S&P volatility, that's a tough game. There are a handful of specialists doing that, but the amount of alpha that's in that market is pretty small.
Yeah.
Whereas in crypto, it is presumably larger, and some of the, say, trend systems, relative value trades, they still work there. But not everybody is there. Not everybody's doing that, right? It's kind of like it opens the space up for people like us, even the single man, the single woman, to trade in these markets. But speaking about the larger participants, you've just mentioned the release valve, Will. How can institutional investors get access to that release valve? Because I think they probably want it, but they fear that they may be doing something wrong. We've seen it on the corporate balance sheets, MicroStrategy, and so on, but I've yet need to hear about a big pension fund or a sovereign wealth fund having an allocation to Bitcoin. Maybe you know of some that do, and I'm misinformed, but I don't know that there are any.
We had a Mass Mutual, I think, was probably the...
But for their treasury.
Right, yeah.
I don't think for their clients, not for their pension clients.
Yeah, thus far in the US, I think most of the dollars from traditional institutions has gone through venture funds. So A16Z, Paradigm, funds that have a long history and pedigree have been, quote, safer for institutions to invest and allocate to. I think it's been a slightly slower pickup on investing in hedge funds, just because of operational due diligence, things like custody, institutions still getting their head around. But what previously was more of a career risk and headline risk, I think, has dissipated. I think it's being much more accepted now for fund institutions to make an allocation. And then in terms of my own recommendation to these groups, I think there's a couple of core assets that you could own passively, and there's increasingly more vehicles to do that. And I think similar to hedge funds in the 90s and 2000s, there's a tremendous amount of opportunity to outperform given just the volatility, the informational asymmetry, et cetera. So like if you look at the HFRI indices that track hedge fund performance, they greatly outperformed the market in the 90s and 2000s, and then you had this last 10 years of underperformance. So I think we're kind of in the early 90s from a hedge fund and active trading perspective, and so a lot of opportunity there if institutions are inclined.
So it's probably still an educational piece of work that the industry needs to do, or market makers, exchanges, essentially the entire ecosystem needs to do to educate institutional investors better about accessing Bitcoin or Ether or any of these products. Because I feel they're still scared, they're confused. They're scared about what a wallet is. Maybe some people get their head around this now, but on average, from a broader perspective, they don't really understand that stuff yet.
The most common pushback we get is the lack of a kind of brand name custodian, where they're like, we keep our equities at State Street, we need to be able to keep our crypto at State Street. And even though there are a lot of very good custody products, that seems to be the biggest blocker that we see.
Yeah, but certainly I agree with the education point. I think it's been a constant necessity to educate clients. I think what's different now, again, versus a couple of years ago, is you had last week, I think BofA put out a report on their kind of view of the entire crypto landscape. I mean, the fact that pretty much every bulge bracket bank now in the US has put out a report like that, is offering it to investors. I think clearly there's a bit less friction now, but yeah, certainly there's a constant education. And the space moves so fast. It's like if you bought into the digital gold narrative and that's why an institution wanted to invest, that's only clearly a very small sliver of the various applications and use cases that are there. So
I see a lot of activity from the hedge fund space in options. Yeah, these guys are fully involved at the moment. They recognize the opportunity is there, right? And it's got everything that they love out of a market. And hedge funds are typically set up to deal with this sort of agile flow. They can be more flexible. They can be faster. So in my mind, they're already there. Asset managers, we're having a lot of conversations at the moment, but this is a slightly longer process, and absolutely it depends on custody solutions and all of these things that I'm super excited because it's all out the door there, the solutions. So that's only a matter of time. Where I'm bearish is on banks' participation in this space, which I think is very, very problematic under the current regulatory framework. And although there's serious FOMO out there, the gap to get to where they need to be in order to properly participate in these markets is still very, very big at the moment. Yeah, it's for me, it's mostly chat there. And when they arrive, it's not even too clear to me what it is that they can contribute to this market. My view is that they've probably missed that train, and it's going to be dominated by the faster, more agile market makers, out there. And in the same way that banks have missed, aren't involved in cash equity market making or cash spot anymore, or these sort of areas, they've all moved to more agile players. I think crypto is the same.
I think when we're talking about institutional players, you have to split up into two different categories. You have the crypto native guys, crypto hedge funds, pure crypto market makers, etc. And then you have now the traditional bigger financial institutions entering the space. And if we look at the latter, as you were saying, everybody's at a different part of or different stage of their educational journey. Some guys are just trying to understand how to work out custody, how to buy their first Bitcoin. The more sophisticated guys all have the same sort of entry trade, trading spot versus futures, which is fine. But definitely the educational component is quite important. And then if you're running your own crypto hedge fund, well, actually crypto or long short equity, raising money is a hard gig. The hit ratio is quite low. you do 100 meetings, at the beginning at least, you get 3 or 4 tickets, right? It's even harder when you're trying to pitch your crypto hedge fund, because not only do you have to sort of answer the, okay, but what is your edge type questions. Quite often you have to educate these investors, so family offices, fund of funds, on sort of how crypto works, what is Bitcoin, etc. So different components to take into account.
You just mentioned the banks, Simon. My personal opinion is, I think you've said they probably will miss that train. Maybe at some point some of the banks will be purchased by a crypto firm. Or maybe it's going to be the other way around, because they may be fighting against crypto and then eventually lose that fight. And you will, I think you mentioned digital gold, which is kind of like a narrative that a lot of people use because it's easy to get to, right? It's easy to get to that 500, 550K per coin and have the equivalent market cap of gold. And then what you often hear is, yes, but Bitcoin is too volatile. It's substantially more volatile than gold, 85% implied vol or something like that. But is that really a fair argument, given where we are in the journey of Bitcoin? Because going forward, you could maybe come up with an argument that Bitcoin's volatility is supposed to be decreasing as we move along, and maybe be on par with gold, I don't know. But even if it isn't, you can always position size accordingly. Nobody is forcing anybody to put 10, 20, 30, 50% of their assets into Bitcoin, right? If you vol adjust it, you can have a meaningful contribution that is diversifying to your portfolio, regardless of volatility. What do you think?
Well, the gold 2.0 is kind of becoming a bit of an insult because, gold has been the worst monetary inflation hedge you could possibly have over the last 10 years. So
fair point.
It's almost like, I think I was reading something that gold's up 1% in the last decade. So, and what's money supply is up 800%, 8,000%, 800% probably globally. So, it is funny, isn't it? It is almost kind of, very difficult, I think, to justify allocating to that asset. So I think Bitcoin's volatility should be a very attractive proposition, given how well it's performed in an environment. Satoshi, the white paper, it was designed for exactly this purpose, that there was a huge amount of easing out of the financial crisis. When this happens again, which it ultimately will, there'll have to be more easing. And this is exactly what we've seen, and it's worked exactly as it was intended to. And it gives individuals, not just institutions, which I think is a good thing, access to to hedge their wealth against a system that is kind of, to some degree, as you said at the start, at or nearing kind of a breaking point. Sorry to any gold bugs in the audience.
But I would agree. I think it's a helpful narrative because it's easy to understand, but it clearly, undersells the value of Bitcoin extraordinarily. I think Melton from CoinShares is always out talking about this is not a shiny little rock that you're investing in. And I think what will help, you're seeing a lot of activity right now with Strike Global and the release of using Bitcoin for remittance in El Salvador and making it very easy user experience through Twitter. I think those types of use cases that are, again, also easy to understand, using Bitcoin as financial rails, is kind of the bigger vision, and hopefully institutions can start to understand that, now that it's being done. I think there's over 3,000 BTC in terms of the capacity for the Lightning Network now. So those types of use cases, as they become literally happening right in plain sight in front of everyone, should hopefully get institutions to understand, the bigger picture. Whereas the digital narrative, I think, was just kind of the easy way in, to educating institutions.
I 100% agree. It's it's useful if you're explaining it to your mum, but Bitcoin is so much more than that. It's a productive asset, right? As part of this ecosystem, compared to gold, which is this thing that looks pretty. And to your point about volatility, volatility is very high in the crypto space. But in my mind, you cannot have high growth without high volatility, right? It's a very healthy indicator of what's going on in the whole system. It's because you've got capital constantly being reallocated across different coins, in, out. Why? Because there's innovation all the time. New products, new schemes, new blockchains. So I think it's very healthy that everything's moving around so fast. This is traditional finance squeezed into such a small period of time, which of course means it comes with very high vols. And for our, for us, this is one of our key offerings. Our customers are able to generate nice high yields through selling this volatility, an asset in itself, and generating returns there.
And of course, like at its very core, it's a disruptive financial system. So I think your friend Raoul tells that story quite well. How could that not be a volatile event for financial markets if the incumbents are being displaced?
It will be, and I think people are maybe scared of volatility for the wrong reasons. It's risk and reward as always, and only because it's volatile doesn't make it a bad asset. I mean, when you look at what happened in the past 20 years, at least from my perspective, is that every large investor wanted to reduce the volatility of their portfolios. There was a point in time when they were happy with 20% equity vol on their US large cap equity allocation. They no longer want that. They kind of like want to, dial that down to 15 or 10. Everything needs to be like this all-weather type of behave thing that works all the time. But that is not reality, I think. I think something like that is going to break, be that risk parity, 60-40, all these type of things. Volatility per se is not bad. Sometimes when you say that, then the counter-argument is, well, we like Bitcoin or crypto because of its decorrelated nature and the diversification benefit that you can get when you add it to a portfolio. But now it's no longer there. The volatility to risk assets is increasing, and maybe that is true when you look at like the past couple of months that there has been an increase in correlation over longer periods of time. That I don't see that happening. I mean, there's all these complaints. It trades 24/7. It doesn't have any circuit breakers. There's no volatility bands where the CME would go, I'm shutting that thing down, right? There's a flash crash. It really hurts when it goes down 20% and it doesn't stop. You want it to stop, but it doesn't stop. It just goes on. So that makes it very difficult for them, I think, to access the space. But still, you have instruments, efficient instruments that now allow you to at least put, put the toe in the pot, if you will. There's ETPs here in Europe. By the way, there is ETPs, quite a few big ones, and they're spot backed. You can trade them as a security. You don't have to open a wallet. So all of that stuff exists, and I think that is a good development. Maybe it's just a question of time, another couple of months, years, and then everybody will have that in their portfolio.
One development I'd say that we see on the exchange side is the amount of capital that now wants to buy liquidations every time they happen, and I'm sure you guys see this too. I mean, it really is a pretty eye-watering bid that is there, and perhaps that's what I don't know. They get reversed quicker and quicker.
I 100% agree. It's a market that's set up for high volatility, which makes it much less dangerous. The most dangerous markets are the ones where you expect it to be stable, you allow massive leverage, and then it takes you by surprise. So I'm thinking of exactly the US Treasury flash crash 5 years ago. I'm talking about Euro Swiss. We went, 2012, we were trading at 3% vol, 2% vol, I think even, and then suddenly we see a 30% move. That was extremely dangerous. That took out a lot of institutions and changed the whole face of FX margin trading. In crypto, we've got lots and lots of mechanisms to manage liquidations, margin calls. It's expected. So I find it healthy to keep these levels of volatility. And every washout is...
It was what you were saying. It's a true market. The most dangerous thing, as the SMB learned, is you're suppressing natural interest, and
exactly.
that won't last forever.
And circuit breakers inevitably just create stress on the system. Yeah.
I used to trade nat gas futures, which are commonly referred to as the widowmaker. So I'm not too fussed with the volatility in Bitcoin, but you do raise a good point there. Traditional asset managers are trying to maybe diversify a little bit away from the 60-40 model. Bitcoin looks interesting, but I think the big challenge for them is, okay, this is a new asset class. A new asset class doesn't come across very often. How do I fit this into my existing risk frameworks? How can I fit this into my portfolio? Does VAR, looking at value at risk, does that make sense in the when you hold Bitcoin and things like that?
You can probably fit it into a risk framework. You have a price series, it's ticking, it's 24/7. I think the risk framework is probably less the issue. It's more like the accounting framework. Like, what do you do with that from an IFRS perspective or US GAAP? And do you need to write that down, write it off? I mean, how do you handle that? How do you actually put a wallet address into a pension fund? I mean, how will they handle that if it's not a security? It doesn't have an ISIN. I think this is where they don't know what to do with that yet. And then it's very easy to shy away from that and say, you know what, let somebody else do that. I'm not going to be one touching that one.
Well, I think you have solutions to the market that for now. There are a lot of third-party providers who've been working on tackling those, sort of taxation, accounting issues. That's also like an important development of the industry to highlight, is that all the infrastructure that's been built around crypto on the more operational side of things. So we talk about it a little bit less, but it's really matured quite a bit over the past years.
I think also, again, we mentioned this earlier, but the incentive hasn't been there, right? There's been career risk and other reasons why you won't do it. Now, if we start printing, a CPI number that's in excess of 5% or 6%, and every pension fund's underwater, then it becomes a different incentive to evaluate these asset classes. So I think we're on the verge of the incentives being better aligned, if you will.
And you probably can't get through a macro panel without discussing COVID, but I do think the last 18 months have been so disruptive for businesses, asset managers, and things like that, that anything additional, weird, requiring more work has been delayed, and just with the intention of people just keeping their normal businesses on the road. So I think that may have been.
Talk about risk for a second. I mean, if you trade, you need to manage risk, right? It should be your first thing that you do is look at the risk. And so what is the risk of your Bitcoin investment not working or your crypto investment not working? And I'm not saying that the thing can go, maybe it does go to zero. I don't think the probability, anybody should be in that room saying that the probability of Bitcoin going to zero is zero. Mm-hmm. It may be infinitesimally small, but it's probably not zero. Something could happen that will just adversely affect the market. That may be regulation, that may be banning, that may be this, that, or the other thing, which we don't know. Okay, let's say the probability of that not happening is greater, and you have a greater upside than you have a downside. That creates that asymmetry. What I sometimes hear then is, yes, but long term, come 2140, there will no longer be a block reward. And the entire network is going to be less stable, less secure, because there's going to be less hashing power, because that reward is going to be gone. So will the transaction fees be there in order to still keep that operable? And this is what I liked about your argument. I think people or institutional investors should hear this, is if there's financial rails or applications built on top of the Bitcoin base layer blockchain that can actually ensure that to happen, if it's not all going to Ethereum or other smart contract type of blockchains. So be that Lightning, your transaction over Strike and these type of things, that can actually be a meaningful part of giving Bitcoin a value. If you ask yourself, what is the value of Bitcoin? I mean, digital gold narrative, this, that, the other thing, but maybe it is so much more which we don't know yet, because it can have second and third layer applications.
Well, go ahead.
Sorry, on that time horizon, like probably as a binary, it's certainly, there is a binary element to the trade. It either works or it doesn't, I suppose. But.
Well, I'll say if we just talk about crypto broadly and not just Bitcoin, to me, crypto is the easiest thing to be irresponsibly long over a medium to long-term horizon, because every single piece of FUD or contributor to volatility, whether it's regulatory, whether it's Tether, whether it's China banning, like once those are cleared, then the market's just open to continue innovation and marching along. So I think the market gets very hung up on these shorter term, potential negative events, most of which I believe will just resolve themselves, and the market continues to be, So over a long horizon, I actually think it's very easy to invest in crypto confidently. If you're trying to trade and do other things and be, tactical short term, that's a different discussion. But I think we'll look back in a few years and, the concern about the Howey test, whether Tether's back, like all this stuff will be a funny story that we thought about and we saw way too many Bloomberg articles about, and the market will just kind of continue to evolve. Because again, I think because it's permissionless and peer-to-peer, like people will opt into an incentive structure that makes sense to them. And the market is coming around to that realization. And I think every single time we get a headline, even about regulation in the US, like the market hasn't really been too phased by, the various ways that we think regulation will evolve over the next month, 6 months, 12 months. I think in part because the market doesn't really care anymore. The market's like, it's you know, it has like anti-fragility to regulation, it has anti-fragility to a lot of other, you know, potential attacks. And I think, again, the market's like collectively kind of coming to that realization. But of course,
I mean, it was amazing how little Bitcoin really moved. I mean, it moved initially on the news of China banning it for the 1000th time.
right.
Yeah.
But what, like 2 days later, that was yesterday's news, and the market was higher.
Right. And then also you saw immediately, you know, DYDX, Uniswap, every, you know, decentralized DeFi app started getting bid up. People start, you know, sifting through, well, how decentralized is this? Is the team anonymous, or do they have a regulatory attack vector? Like, the market's getting pretty smart to, you know, what will continue to thrive even in a very draconian regulatory environment. And so I think that's in part why it didn't respond, you know, too much. And Bitcoin itself has more regulatory clarity than most other assets within crypto, so that's also helpful. But
And you guys don't think...
It's very difficult talking about a question with a 20-year horizon. It's when I typically trade for the next hour or the next 2 hours. What I can say is that a core trading strategy of mine is that you know, it's very easy to make money, right? What's more challenging is to make sure that you can survive through all of the downturns, all of the squeezes, all of the you know, any regulatory changes out there. So our core strategy is just to make sure that we can keep trading regardless of the market conditions, because you know, there's money to be made now. Could you make more? Yes, sure. But the big money comes when there's dislocations, and it's when, you know, other guys get taken out exactly with moves like this. So being agile and nimble to be able to take advantage of this is kind of the way to go. And yeah, sorry, and to your point, yeah, I mean the growth in DeFi has been incredible, and I find that extremely encouraging as to, you know, where crypto can go and how robust it can be. I think it's extremely positive for our business.
Well, just to comment on your question briefly, I think, yeah, we can speculate about, you know, is layer 2 or other things on the Bitcoin network, you know, large enough to incentivize continued security for Bitcoin post, you know, no longer having emissions from the network. But I think that we could debate it all day, but I think the bigger thing to recognize is how much money is being invested in infrastructure around Bitcoin today. And so the financial incentives that will exist 10 years from now, 15 years from now, to figure out that problem, whether that's actually a change to, you know, Bitcoin, the protocol, through, you know, various bit proposals, I just think that it has the ability to adapt, and we don't, you know, answering that question now is not too relevant, in my opinion. And I think so long as, again, there's a financial incentive by the market to address that security issue, if in fact there is one, because, you know, Lightning or anything else built on top of it's insufficient, again, I think that the market will solve for that.
Because you think the stakes will be too high then, like 15, 20 years down the road, Bitcoin being higher, the industry will just take care of the thing.
Yeah, I mean, we're talking about El Salvador today. You know, Brazil is talking about making illegal tender tomorrow. If in 3 years we have several other countries who now have adopted as legal tender and hold it on their balance sheet, then the stakes have become, you know, extremely high. And so, again, if we just kind of keep a course of growth that we've seen over the last few years, you know, over the next, you know, 5 years, or accelerate that further, yeah, I think there's huge incentive for the system to be, problems to be addressed.
Staying with that risk topic just for a minute longer, I mean, yes, we've talked about these exogenous risks, like, you know, there could be regulation, there could be banning, interventions, all these type of things, attacks, right? Is Tether a risk, or would that just also be one of the things, if it happened, if something bad happened, it would just blow by, and 2 weeks later, nobody cares?
Well, people that use Tether are less worried about Tether than people that don't use Tether. People that don't use
Which is
Tether,
weird.
Yeah. People that don't use Tether aren't shorting Tether, I don't think, really. So I think it's quite hard to think there'll be a run on Tether. And then correct me if I'm wrong in terms of what the question's implying, is the question how much of Tether is backed? Because if you look at it, I think they said they own 30% of commercial paper. And then if you said, say, 10% of that is in commercial paper that might be Evergrande or something you might not want.
Dodgy.
Yeah, dodgy. There you are. To use a British word from the American, So then you've got a 97% backed stablecoin. I don't think that's. I personally don't think that's like a systemic event, because people don't hold Tether as like a safe haven in the space.
I agree with that. Look, I'm
No.
absolutely neutral on the point,
Yeah.
right? But so nobody, I mean, certainly I don't really know what's going on. People are trying to figure that out.
Yeah.
So I just brought that up because there was a Bloomberg news story this morning, and they're saying, look, we know about the commercial paper, but really when you speak to people in the market that trade commercial paper in the United States, they don't recognize Tether, the counterparty, under the banks as their counterparty. So are they really there? And then that story went on to suggest that, oh yeah, the commercial paper actually sits in China and it has exposure to Evergrande.
Right.
So boom, right? So that is good news. That's good clickbait. But if something happens, I mean, I don't know, does Bitcoin go to infinity because Tether is at 0? Or does Bitcoin half or go down 80% because the entire system breaks?
I mean, the reality is that Tether constitutes between 40 and 50% of exchange spot volume. So it's clearly impactful for liquidity. Yes, short-term people dumping Tether to get into the next liquid thing could be beneficial to Bitcoin. But I think it does impact liquidity. You also have 11 billion in notional in smart contracts, so that has implications for DeFi if all of a sudden people are concerned about the value of Tether. Again, speaking to funds and OTC desks who trade in this heavily, none of them seem to be particularly concerned. They've all sent dollars, got USDT, they've all redeemed. So, and if you look at the trajectory of USDC or any other stable coin, yeah, more people put money into the system as the asset class goes up because it's, you have fiat on-ramps. So, again, I'm not saying there's no risk there, and I don't, have the transparency to be able to say that, but at least other market participants seem not to be as concerned as the Bloomberg clickbait article would have you believe.
Yeah.
And again, it's another one of those things where if you finally get that out of the way, like if Tether goes away, that has to be also quite positive for crypto markets in general. I mean, everyone was worried about Chinese liquidity or China's retail liquidity, and we saw them completely banned, and the market really hasn't, budged after, conceivably moving a big cohort of traders in demand from the market. So,
but it certainly is keeping money out of the market. I mean, no question.
It's keeping out of the market.
Yeah.
Yeah, no question.
Because people are scared and they don't even want to on-ramp if Tether is there.
Well, you're a new asset manager. You published the day after this Bloomberg article that you bought Bitcoin, and then Bitcoin goes to 0 because Tether blew up, and your investors are like, well, yesterday, didn't you see this? So I think there definitely is. I think from speaking to hedge funds, like traditional hedge funds that invest in crypto, they get a huge amount of nervous questions from their investors about Tether. It's the most common question, I think.
I get people asking me a lot how to short Tether who aren't in crypto. They're just like, they read articles like, how do you short Tether? I'm like, well, you can pay 11% a year and be short. That's your carry cost, and have at it.
And I see some concerns actually amongst even like pure crypto hedge funds who have got questions from their investors, what's this Tether, what are the risks, et cetera. I mean, you have, as you know, other stable coins have been introduced, financial instruments on those as well, so you can diversify away a little bit if needed.
And our investors ask us about our exposure to it as well, so it's definitely holding back capital from the space. So to Will's point, if we were to get more enforced clarity, which you have to think is coming.
What I find fascinating, interesting, I mean, spontaneous question, I don't know the answer to that, but if people say USDC and other stable coins have a better backing, and say that's true, better than Tether, more transparent, why doesn't the market immediately move there, like in a kind of like in a jump? Why is Tether still growing?
People have just got
liquidity brings liquidity, right? It's it's still the most popular means of exchange within the crypto sphere. So, yeah, I mean, these are questions that we've heard for years and years and years, right? And it's still there, and it's still traded. And we run on and off ramps ourselves. Not a concern. I think we've seen enough disclosures now, satisfied that it's solid as anything in the crypto sphere, I think.
I mean, I think USDC has a bit more, the on-ramps, the KYC and AML required to mint USDC, like for retail, is certainly higher. I think that's probably part of why you don't see that. You also are able to blacklist addresses on USDC, so that could also keep some, entities away. I mean, I would almost reframe the question and say, well, why isn't DAI, 5 times as large when it's, permissionless and collateralized by crypto, and over-collateralized and transparent?
Good question.
And I think again, back to a point I made earlier, it's like if regulators push on this, then to me, DAI is just the escape valve. It's like, okay, well then we've already built a mechanism to create stablecoin, and yeah, like that has its own vulnerabilities potentially, right? It hasn't been tested and stress tested the same way other stablecoins have, but it's gone through, March of last year, successfully with some, changes to the protocol, and continue to evolve.
But I think you touched on something important there, right? It's each time you try and poke and regulate crypto in different areas, it manages to pop out and squeeze it in all sorts of places. The regulatory tools available at the moment just aren't suited for crypto. It's regulators have got their they're fighting their own Vietnam War, right? They're going in there with the wrong tools to try and control an industry that's acting in a completely different way. It's much more nimble, it's much more agile, they're not quite sure what they're trying to regulate, and even the objective is unclear. And right now we're seeing in the US, even the home support for this regulation is evaporating. It's for me, it's
not even clear who's doing it in the US. Which regulatory body is going to be doing it? They can't agree on that.
Exactly. So, there's a little bit of carpet bombing attempts, but this isn't. Ultimately, it's going to fail, and I think it's very encouraging to see this sort of political shift that we've got at the moment. This view that, China's cracking down, perhaps crypto could be good for us as a source of economic growth. I think that's very encouraging, and I think that's what's needed. A rethink of, okay, what are we really trying to control here? Maybe there's some different tools that we can use.
Good. I'll spin that discussion around one final time before we're going to open it up. Yeah, we'll have questions in 2 or 3 minutes, if that's okay. One big topic for institutional adoption across the world, mainstay topic, is sustainability. And what could the industry do to convey that better? I mean, I think Dan Moorhead from Pantera has done a fantastic thing on the S and the G of E as and G, saying that the S and G is actually super positive with regards to Bitcoin, but when you equate the E for environment with C for climate, a lot of people freak out. What is it that could be done better there?
I think including crypto in the ESG narrative is fantastic. If we take a step back and look at the growth of the ESG assets under management, it's been incredible. When the first ESG sort of hedge funds started to launch, it was actually quite a hard, challenging environment to raise assets, and within a couple of years, funds that were at 20 million were at 1 billion. So it's been really great growth. Coming to crypto. I think it's all going to go through innovation. You have miners now that are working with oil drillers to recycle the natural gas that they can't move through the pipes, and instead of flaring the natural gas, they'll recycle it and mine Bitcoin. I saw this company in Spain the other day who was using bioenergy from methane to mine negative footprint. Well, mine Bitcoin with a negative carbon footprint. So. Progress is being made in the right direction, and I think somebody the other day on a panel raised a really interesting point: is that if this progress is not going to take shape, all the ESG managers won't be able to invest in crypto. So I think we're on an initial path, but the right path.
I think it's one of education as well. I think the renewable mix of Bitcoin, I believe, is much higher than any other industry. I think it's one of the few things that can co-locate next to sources of power or be used in all the innovative ways that he just outlined. I think you also have to ask yourself the question, is the other benefits of it outweighed by the energy usage? I read somewhere that the US uses more electricity for Christmas lights each year than for the Bitcoin network. I don't know if that's accurate, but it's the right question. Say, like, do we use energy for other things that may not be as beneficial to humanity as Bitcoin potentially is? And of course, as we all know, there's a number of other consensus mechanisms that are more energy efficient, might have some other drawbacks. But again, I think there's a huge area for innovation there, a huge area for education. And I think right now, at least institutional investors, read that headline, don't dig in and do the homework. And again, I think...
I agree with you. I think it's a matter of perspective. People get it the wrong way. They immediately convey that to a waste of energy. And then you read headlines like it's consuming as much as the country of Norway or things like that. It's very difficult to prove that in the first place, whether that's true or not. You're wasting energy on a bunch of things, Christmas lights, for instance. So I think it's a matter of education, and over time people will come around. I mean, if mining is done with renewable energies, I think that must be the prerequisite. That must happen. You cannot burn coal to do it. You can, but you shouldn't.
Yeah.
And then it should work. Well, thank you. We want to have some questions. We have 3 minutes left. One very eager.
All right. Thank you very much for giving us a macro perspective. Actually, I was thinking that blockchain, we all know that was the best thing that happened in finance in these recent years. And we know that most of the people are not crypto community at the moment. What do you think when a government, or let's say EU or US, decides to give another option, not ban like China, but give another option into the blockchain and let the banks build a layer 2? What do you think will happen, let's say, to the crypto community at that moment? I mean, it will be risked, or it will be challenged, or I mean, government will trigger this non-crypto community by giving them an option from the government. So, what do you think the markets will?
So there's a good meme right now about, I think, like it's like an ICO, which is like USDC. And like infinite, no supply cap, like, continue to print it. Like, it doesn't matter if you digitize dollars.
Yep.
I think that the core problem with you're trusting someone to make a decision and how much you can print, and you can print it into impunity, still exists. So I think it's a helpful monetary policy tool. Like if you want to direct stimulus to a certain demographic because they're hard hit by COVID or whatever, it gives you a finer tool. But I don't think to me, it doesn't change the value proposition for crypto in any way at all, because it's still the same problems we have with monetary policy today will exist in the CBDC.
Yeah, just from a macro perspective, I think the biggest driver is the need and growing demand for a decentralized store of value, and that's really the key thing. And there will be great value in a digital real fiat currencies, but it might actually be helpful for Bitcoin because it just brings much more capital into the digital space.
I think it solves a completely different problem, because it's this other country. But CBDCs, I think it's super exciting, and sort of China's taking a different approach. They're saying, okay, this is ours, and you're going to go with this. But that's great. We're going to see, incredible adoption and comfort created in the blockchain and around that. It can only drive more innovation and more creativity. I mean, what I'd love to see is not just a CBDC, but a government-backed blockchain that has computational capacity, right? The ETH of CBDCs, or the algo, or the whatever. It's I think that'd be truly exciting.
Great. Unfortunately, we are out of time. It's been my pleasure moderating that panel. Thank you all very much. By the way, I think we're all around. If you have questions, see us for a coffee. Thanks very much. Enjoy the rest of the conference.
Thank you.